Thanks so much for tuning into this Q2 conversation with the management of Angel One. Mr. Narayan Gangadhar joins in. Remember, the Q2 had surged 18% quarter on quarter, 15% YOY. And the profitability beat, to my mind, was driven by maybe a small beat in the operating revenue, which rose about 8% or 52% YOY, as the case may be. And outperformance by because of the 10% beat in the net interest income as well. The FNO share and cash market volumes after a string of declines have also inched up a bit. So let's put all of that into perspective with him. Narayan, great having you. Thanks for joining in. Hope all is well.
Hi, Neeraj. Great to have you on great to be on the program as always, and looking forward to our discussion.
Yes, indeed. As I'm sure a lot of people who will watch this are. So Narayan, put this into perspective. These are choppy times. How would you dissect what happened in quarter two? Simply because your profitability, arguably because of certain metrics that I mentioned, as well as cost control, has actually not shown any signs of stress.
Yeah, great question. See, this quarter has been a subdued quarter with a good set of buying opportunities that emerged through the course of the previous 3 months. And combined with that, we have already seen a lot of inflationary headwinds coming from the more developed economies. And in response to that, I think India's anticipatory stance on interest rates has actually helped the market. We were thinking it's with the kind of interest rate hikes we have had this year, almost the fourth one now, and there's actually many economists are saying there's a few more left, right? We thought that there would be a contraction in the market, but clearly what has happened with local capital coming in, there is a lot of buoyancy which is being maintained in the market, which we believe is here to stay. And clearly that reflects in our numbers, as you yourself rightly pointed out. And you made an interesting comment, Neeraj, about the mix of the volumes, right? And see, what we see there is that there's not only FNO, but there's also cash and commodities and other segments which are heating up, which I think is a great thing for the country, because it just means there's more diversity in the mix now.
Yeah, and I was going to come to that in a moment, because there was I stand corrected. I didn't point out commodities because I think there too your market share, I presume, has and volumes have moved up. But I'll come to that in a moment. First, the headline, a couple of numbers further, Narayan. One, the cost to income ratio, I thought improved or rather showed the right tick in this quarter. Now I know usually brokerages want to operate in a band. They would probably not care too much about it when they are on a marketing or an advertising blitz versus otherwise. What's your sense? Can you fill us in on this?
Yeah, a very good question. See, Neeraj, as we already also discussed in our last conversation, right? We are in a growth phase right now. So our goal is really not to conserve capital per se. Our goal is to operate the business at a healthy OPM of anywhere between 45 and 50%. Now, for the last 2.5, almost 3 quarters now, we've been running it at around 52% OPM. So, historically, I don't expect this to continue. I expect us to fall down to the 45-50% range, and we are very happy with that. There's a very healthy, set of numbers to have for a business which is almost doubling every year. So, with that in mind, what we are seeing, Neeraj, is that as we have scaled, unlike many of our unlike many folks in the industry today, we are actually one of the only ones who are growing at this rate. What has happened is we have hit some economies of scale. Because of this, our internal utilization and operating metrics have improved. And thanks to that, some of these core numbers that you see are also showing very healthy signs of growth and improvement. So overall, I feel this is a very healthy trend line. But again, mota, if you look at the big picture, our headline number is always going to be, what do we run the OPM at? 45 to 50%. That's where we aim to operate it.
Yeah, so maybe OPM has never become the headline, and which is probably good. But the reason I brought this up this time around yet again, Narayan, was that somewhere in a note I read that you or somebody from your team has said that the employee expenses are structurally heading lower. So therefore, would it mean that if you operate within this band of 45 to 50%, with employee expenses having gone down, that you are looking at wanting to continue to grow and wanting to continue to spend on client acquisition and advertisements in the near future?
Yeah, very, very good question, actually. So let me just give you some color on that, right? So what's happened is this year, we came up, our strategy was to launch the super app and to launch a, like a platform with a Pareto set of services, like mutual funds and such, and we are about to do that in Q4, in Q3, and then later on in Q4. So this, for the next quarter and 2 quarters, what you're saying is spot on. It's like, I don't think our expenses are going to be increasing by much, right? However, next year, we do believe that when we redo our, when we look at we are launching, that these economic parameters will change, because we are going to go back again into the investment mode. Whereas now, because we have executed well through the year, the next 2 quarters are going to be very smooth. I mean, in the sense, they're smooth in the sense they're going to be within the right ballpark of what we have published.
Okay. Just one slightly broader question on that. Tech businesses typically have a very large upfront scale-up expense, maybe, and please correct me if I'm wrong. And then they get into, to an extent, the maintenance mode for a large portion of the tech, because the product is built, right? So where, in your case, because you front-loaded so much of your tech expense and built such a powerful tech platform already during the COVID times, what happens to that? Because I'm presuming that you still consider yourself a tech first company.
Yeah, absolutely. And the answer is very clearly this, right? As we have to continue increasing our investment in tech. It's, in fact, the investment in technology, investment in people, investment in employee stock option costs, they're only going to continue to accelerate. Largely because we got to get the best people in the industry on our teams, not just the technology team, but also the business teams and others, so that we build this holistic business. So this is why, while it's very much like balancing a beanbag, right? Sometimes you try to put a pressure in one direction and then something else pops up. So what we look at is, what's the overall envelope? How do we keep this business growing at 2x, at 100% year on year? How do we get the overall OPM within the 45 to 50% range? Within that, everything is fair game. Even if the OPEX goes up, I don't lose sleep over it, because overall we are hitting those right benchmarks.
Okay. Fair call. Now, the statistic that you were partly referring to, I saw F&O growth momentum remaining resilient. Cash broking revenue quarter on quarter increased for the first time since Q1 FY22, if I'm not wrong. Now, are these developments that were planned, Narayan, or they happen if they have to happen in a particular quarter because of how clients are trading?
There's nothing particular like we have done, differently. To answer your question, right? There's nothing different that has gone on. However, what has happened is we have continued to invest in curating client journeys. So because of that, the client behavior has changed. Now, I can't attribute the shift in the numbers essentially to market. The only thing I can actually logically attribute it to is market conditions. But there's also an undercurrent underway where, because our curations, our new journeys are taking place, some of these numbers are influenced also because of that. Now, we haven't really put a science behind it as to what percentage is due to what and whatnot. So just to be very candid in terms of how we are looking at it.
Okay, so then the cash broking revenue going up or going down may not necessarily be a planned event, but happens because clients would behave in a particular fashion.
Absolutely.
But what about derivatives? What about commodities? Because those two.
So those are a little different, right? So for example, for commodities, it's very clearly our product is just head and shoulders better than the competition in terms of the kind of options that we offer for these commodity brokers to trade on our platform, and the kind of mobile app strategies we have pursued on the commodity side. Like, all that is bearing fruit, right? Now, on the F&O side, what has happened is we have fine-tuned our strategy to get a little bit more conservative in terms of how we bring people onto F&O. So we spend a lot more time making sure that the clients they have a full understanding of what F&O trading is all about. We have raised the bar actually for people to onboard onto F&O, because it's one of those areas which requires a lot of proper planning on the investor's part before they start trading. So I believe some of those changes have actually helped accelerate the business rather than decelerate, because we have gotten better at filtering at the filtering process, and ultimately that is showing up also in terms of our volumes and things, which is what showed in this quarter's number.
Sorry, so are you saying that sustainable volume clients are now a large bucket, and that's why
Yes.
they keep on trading, and that's why the volume stays?
Yes, that's right. That's exactly right. Which is a very healthy sign. This is the first quarter in which we are seeing this sign. And I mean, we have seen bits and pieces of this in the previous quarters. But what we are seeing now, Neeraj, is that this trend, if it continues, as it continues, now we are looking at a very, very strong, acyclical business model, which will be here to stand the test of time. And especially because the market itself is growing and penetration is so weak.
Okay. Just before I get to my final question, one more question on a statistic which I read.
Yeah.
The revenue per client. Now that's now come off materially, right? I mean, Q1
Yes.
FY23 or Q2 FY21, sorry. It was
Yeah.
720. Q2 FY23, it's 430.
Yeah.
Now, does it happen because pandemic times were unnatural times, or is it because as you onboard more people, a statistic will naturally come down? And where does it stabilize?
I think it's the latter. It's clear. It's clear. See, as more and more people come online, clearly we are transitioning from a boutique business to a large commodity business. So for the next few years, we are going to see this normalization of the trend to continue. Now, this is why when we look at the business, we look at, okay, we are achieving economies of scale. So let's go back and look at the total order count. And the total order count this quarter, if I'm not wrong, it was around 228 million or something like that. So these numbers is what drives our high order bit.
Okay, so you do reckon that this revenue per client may go down, but because you are constantly in this wake of getting more clients, it's not a drop that will bother you too much. It's a natural
because
of the process.
No, it doesn't bother me, and there's another reason for it, because most of these clients were coming in today. They are between the age of 25 and 30. Okay. Now there used to be a time where only 30-year-olds would get into broking. So your average lifetime value is only spread over 5 years, 6 years max. Whereas these guys who are coming in, their LTV is 10 years, 15 years. So we have enough time, and we are already seeing signs that a candidate, if we give them the right experience, regardless of wins or losses, for the second year, they tend to diversify and they stay with the platform. So which is a very encouraging sign,
Got it. Now, Narayan, because of the change or changes that are happening with the monies that have to be given back to clients in X number of days versus earlier, do you reckon this free broking that some of your peers are all, you guys are all leaders of this space per se, right? You disrupted this pocket. Would free broking become a thing of the past very soon, or would it continue?
So, see, first of all, these regulatory changes which have been imposed by SEBI, they're actually very welcome. And I'll give you a small example. What it does is it creates institutional trust in pretty much our broking platforms, which is what we really want. If we want to get to 10 million, if we want to get to 10% penetration, we actually need the regulators also to continue to strengthen the overall ecosystem. So overall, I think this is a huge positive. Now, I'll give you actual proof. Actual proof is, on October 7th, we were asked to do a funds payout. This was the first time SEBI mandated all institutions to do it. On 7th of October, we did the payout. Usually, when we do the payout, it takes a long time before the money gets back. On Monday, we clocked almost the same. We, in fact, clocked more orders on the subsequent Monday than we did the previous Monday when the money was with us. And we got the full money back into our accounts within 5 days, because we took this opportunity to improve our product experience. So every such opportunity where the regulator is coming in hard, it opens not only a bigger window for the clients to come in, because their institutional trust is very important for us to continue long term, right? On broking as a business, not just Angel, everywhere, right? And secondly, it is actually creating a significant advantage for technology-led players to innovate fast. So I feel like this regulation, when you look at ASBA is about to get launched next year. I think all of this is a step in the right direction. And we truly are excited about this space. Yeah, we may have some, we may lose some business here and there, but we care about where we are, the batting average, over a longer period of time. So which actually helps us.
Next time that we talk, I would love to understand what the experience has been for the subsequent 3 months as well, wherein you've remitted the money and how does it come back. It'll be great to have that statistic the next time we talk.
And we will have more data also to share at that time.
Likely. Narayan, one final question. Would you be in any need of raising any kind of equity capital over the course of the next 6 to 9 to 12 odd months?
No. We are completely well capitalized for the next.
Despite the tech spend that you're talking about, no capital raising required.
Nothing.
Great. Well, we wish you all the best. Thank you so much for talking to us today, and happy festivities.
Yeah, thank you, Neeraj. Yeah,
Bye-bye.
Have a good one.
Thanks for tuning in.
Thanks.